My greetings to everyone. I am Professor Dr. Namita Rajput, Professor in Department of Commerce, Aurobindo College, University of Delhi. In the ongoing series of Finance for Everyone, today we will be talking on behavioral finance. We will be talking more on the common biases, the process of making decisions, investment methods, emotional knowledge, risk tolerance, real-world example, the prospect theory, and nudging and behavioral finance. So let me start with the introduction part. The behavioral finance examines how the emotions and the mental state affect the financial decisions. This interdisciplinary field incorporates the economics, psychology, and the sociology to study the irrational aspects of individuals and the organizations when making the financial choices. Now we talk about the traditional finance. It assumes that the investors can make a rational decisions, emotional biases, heuristics, and other psychological elements which often influence the people's decisions. The study of the human behavior in the financial markets and its implications on the economy is called as behavioral finance. India's rich and complex culture give rise to its own set of behavioral biases and heuristics, making the behavioral finance particularly relevant in the Indian context. The financial illiteracy makes the Indians susceptible to a prejudice and the emotional decisions. India's love of gold, property, can impair their financial decisions. Many Indians have a herd mentality, following their peers' norms, and this can actually produce the market bubbles and the impulsive trading. The behavioral finance is very crucial while investing in India, a complicated and ever-changing economy. So if they can identify and overcome their behavioral biases, individuals and the organizations can make a better financial decisions and achieve their goals faster. We'll talk about the common biases now. The confirmation biases. It is all about the preference for supporting the evidence. The investors may make a bad decisions because they can't digest the information that contradicts their beliefs, and investors may search out the publications and the analysis that corroborates their stock beliefs and dismissing anything that opposes them. The next is your overconfidence biases. It's actually common to overstate one's ability to judge. Investors can overestimate their investment performance or take a needless risk. So a successful investor may start taking the risk. Next is your loss aversion. Taking the failures harder than success. Yes, the investors may stick on to losing investments or avoid a high risk opportunities. Now for the fear of compounding their losses, a stock market may hesitate to sell. Next is your anchoring the bias effects. The first evidence biases in the decision making. The investors may overvalue the amount they pay for a stock or other investments even though the market has changed. Next bias we are going to talk upon is the availability bias. Yes, the overvaluing easy to get information. Some investors, they value the breaking news over the fundamentals. Next is your herd biases. Conforming to the majority standards, the investors may buy or sell the stocks without first examining the market or the fundamentals, relying on their investment behavior. Indian investors can boost their long-term gains by recognizing and overcoming these cognitive biases, making more rational investment decisions. Now we are talking about the process of making the decisions. The first and the most crucial step to overcome the impact that one's own behavior biases have on the decision-making process is acknowledging one's own prejudice. For the investors, the time spent understanding one's own biases and how these biases may be influencing their financial decisions is time well spent. The next is your information acquisition investors. The information acquisition investors should make it a point to get as much as information as they can from as many diverse sources as they can, rather than depending on a very smaller number of sources, then confirming their pre-existing ideas. Now, by doing so, the biases like availability biases and the confirmation biases can be overcome. And after the information has been obtained, it is very critical to assess its objectivity and base your conclusions on its merits, rather than letting the prejudice or the prior notions influence your judgments. So, the investors need to be aware of the overconfidence biases and take the necessary steps to lessen it. The investors should seriously consider a variety of options before committing strictly to one's own course of action when making decisions on their assets. Now, in order to avoid the anchoring biases and make sure that the decisions are based on the most recent and the meaningful information available, so this will be really helpful. Now, it can be advantageous to seek the opinion of others who might have a different perspective on the investment decisions, since those people may have a different point of view. So, this can aid in avoiding the herding biases and ensuring that the judgments are based on a variety of viewpoints. Now, investors should refrain from making the decisions based on a momentary market changes, on their emotional responses to lose and for the losses, and instead stick to their selected strategy once they have made their decisions. So, this can really help the people to get over their fear of losing the money and make the decisions with the long term in mind. Now, by following these guidelines, the investors can lessen the influence of behavioral biases on their decision making. Now, which could lead to a better investing results over the course of a longer time frame. The next is your investment methods. The investors diversify by investing in multiple asset classes. Diversification is the asset allocation, and diversifying the portfolio assets can really lessen the impact of portfolio performance on stock and the market performance. So, this reduces the herding biases and anchoring the biases by preventing the investors from fixating on certain stocks or the market patterns. Next we have is a dollar cost averaging. The dollar cost averaging is an investment technique in which the investor regularly invests a certain amount in a specific asset or portfolio regardless of the market performance. So, consistent investing helps mitigate the overconfidence biases and the loss aversions. This makes emotional investing decisions based on short-term market changes less likely. Now, the value investing seeks discounted stocks and other investments. The fundamental analysis drives this particular search, and the fundamental analysis rather than the short-term market movements might assist the value investors avoid confirmation biases and available prejudice. Next we have is a systematic investment plan, which we call it as SIP. The investor invests a fixed amount in a mutual fund monthly or quarterly using a SIP. So, this method reduces the market timing and the overconfidence biases because the investors use the same strategy regardless of the market performance. Next we have is a long-term investing involves holding the investments for years. The long-term investment in this by focusing on long-term trends and the basic analysis. The investors can avoid arcing and herding tendency, avoid anchoring and herding biases. Now, this investment technique can really help the investors overcome the behavioral biases and make more rational investment decisions, which may enhance their long-term results and profitability. Let us now talk about the emotional knowledge. The self-awareness and the self-awareness investors that possesses the emotional intelligence are able to recognize their own emotions. Yes, we are talking about the personal prejudice and the manner in which these aspects they affect the financial decisions. And by exercising self-regulation, investors can learn to control their emotions and steer clearly off. Next is your empathy. Empathy is a very crucial facet of the emotional intelligence that really helps the investors understand the decisions made by the market and as well as those of the other participants. Now, in order to benefit from the experiences and the viewpoints of other investors as well as from the experts themselves, so the investors might have a strong social skills, and those qualities enable them to establish the connections with other investors and financial professionals. Next we talk about is a better ability. Better ability to make the informed and the logical decisions. People with the high emotional intelligence are better equipped to make informed and the rational decisions about their investments. The investors that are emotionally intelligent and have the emotional intelligence can better manage the risk and make more thoughtful investing decisions, better investment judgments, and can also be made by the investors. Now moving forward, considering a bigger picture, the investors that possess the emotional intelligence are better able to stay focused on a long-term goals and the tactics. The investors that possess the emotional intelligence are able to adapt and change their investment strategy in response to changing market conditions or recently learned facts. By improving their emotional intelligence, the investors can better comprehend their own biases as well as the action of other investors and the market. The long-term investment results may be improved as a result, potentially resulting in a greater financial success and the satisfaction. And next is your risk tolerance. The risk tolerance is an investor's capability and the capacity to handle the portfolio losses and volatility. The personal circumstances, the financial aspirations, and the behavioral biases, they affect it. The cognitive and emotional biases can actually lead to irrational investing decisions. So these biases can greatly affect the risk tolerance and the investment strategy. Let's examine the risk tolerance and the common behavioral biases. The first is your loss aversion. The losses hurt more than the profits. The investors focus on avoiding the losses rather than making the gains, which lower the risk tolerance. So therefore, they may choose the conservative investment methods like cash or low risk investments, even if it means missing out on better returns. Next is your overconfidence. So the people with the overconfidence bias think they can forecast the events and make the good financial judgments. Now, assuming a greater skills and expertise, overconfident investors may take on more risk than they can handle, increasing risk tolerance. So they may make risky investments without contemplating the risk. Next is your herding behavior. People tend to follow a crowd investment judgments, So this bias amplifies the market sentiment and affect the risk tolerance. The investors may take additional risk during the market, excitement, believing that the market is going to rise, and the investors may become risk aversive during the market panics and the self investments at unfavorable prices. Next is we have a anchoring biases. The decision makers over rely on initial information or the referral points. Investors may base the risk tolerance on the past experiences or the market conditions. And even if the market conditions are very different, an investor who lost a lot in a market crisis may become more risk averse. Then as we all have a confirmation bias. They tend to seek and interpret the information to confirming a pre-existing views on the biases. The investor may prioritize the risk-related data, and the risk-averse investors may focus on unfavorable news and investment losses, which may increase their risk aversion and lower than their risk tolerance. So the investment techniques are affected by these behavioral biases, and the investors must understand and manage these biases to make the educated judgments. Considering the personal circumstances, the financial goal and the risk tolerance is very crucial. The professional advice, diversifying the investments across the asset classes, and assessing and altering the investment strategies can really help eliminate the behavioral biases and provide a very reasonable and suitable risk management approaches. Let me give you now some real world examples. The first is about the real world examples of behavioral biases and investment strategies. Let me give an example of the confirmation biases. An investor strongly believes in the potential of a technology company and only seeks the information that supports their belief while disregarding the contradictory evidence. They allocate a significant portion of their portfolio to the stock, ignoring the warning signals or the critical analysis. And if the market underperforms, the investor may suffer the losses due to this biased decision making. Now let me give an example of a herd mentality. A stock experiences a rapid rise in the prices due to positive news or the market sentiment. Now, seeing others profiting, many investors jump into this bandwagon and buy the stocks without conducting a proper analysis. However, when the market sentiments changes, these investors may suffer huge losses. Now let me give an example of the overconfidence biases. An investor consistently achieve the above average returns on their investments, leading them to believe that they possess a superior stock picking skills, and as a result they take excessive risk, fail to diversify their portfolio, and overlook the importance of the thorough research. Next we have is a loss aversion. An investor holds on to a losing investments for too long, hoping that it will eventually rebound and avoid realizing the loss. So this bias can really prevent the investors from cutting their losses and reallocating their capital to more promising opportunities. So similarly, there are the few examples which were actually the behavioral biases that we have discussed that affect the investment methods. The investors should be aware of these biases, how to take a rational decisions, how to take the actions to counteract them, and such a rigorous research, portfolio diversification, and independent opinion. Next we are going to talk about is a prospect theory. The prospect theory is a behavioral finance concept developed by Daniel, and it proposes that the individuals do not evaluate the potential gains and losses in a rational and objective manner, but their perception is influenced by the psychological factors and the biases. Now, according to the prospect theory, people tend to place more weight on the potential losses than an equivalent gain. So, in the prospect theory, decision making is based on two key components, the value function and the decision weighing function. The value function describes how individuals perceive and evaluate the gains and losses. So, it suggests that the people experiencing the diminishing sensitivity to gain and increasing sensitivity to losses as the magnitude of the outcomes increases. In other words, the psychological impact of gaining rupees 100 is perceived to be less than the impact of losing rupees 100. Furthermore, the decision weighing function explains how individuals assess the probabilities and make the decisions under uncertainty. This particular prospect theory suggests that people tend to overweight the low probability events and underweight the high probability events. This means that individuals may take greater risk to avoid certain losses, even if the likelihood of a possible outcomes is very low. So, the prospect theory has significant implications, ramifications for the investment decisions and the risk-taking behavior of the investor. It also suggests that the investor may be more willing to take the risk to avoid the losses rather than pursuing the potential gains. For example, investors may hold on to losing investments in a hope of recovering their losses, even if it goes against the rational investment principles. Moreover, the prospect theory suggests that individuals may be risk averse when it comes to the potential gains. So, they may be inclined to settle for smaller but certain gains rather than the risk for the potential high returns. So, this behavior can actually lead to a missed investment opportunity and suboptimal portfolio performance. Now, understanding the prospects theory can actually help the investors and the financial professionals better comprehend the biases, then they can impact the decision making. Now, by recognizing these biases, the individuals can strive to make more rational investment choices. The strategies like setting clear investment goals, diversifying the portfolios, and focusing on the long-term objectives can really help in mitigating the influence of prospect theory and promote more balanced decision making. So, in short, in summary, we can say the prospect theory highlights how individuals evaluate the potential gains and the losses differently, with a tendency to overweight the losses and exhibit the risk-averse behavior when it comes to the gains. So, by acknowledging these biases, the investors can make more informed decisions and develop the investment strategies that align with their long-term goals. The last is the nudging and behavioral finance. Nudging is a concept rooted in behavioral economics and the behavioral finance that aims to influence the individual decision making by using a subtle cues or interventions. It recognizes that the humans are prone to biases and irrational behavior and seeks to leverage these tendencies to encourage the positive outcomes. And in the context of behavioral finance, nudging involves designing the choices environment that steers the individuals towards making a better financial decisions without restricting their freedom of choices. The idea is to nudge people towards the choices that are in their best interest, aligning with their long-term financial goals. Now, one well-known example of a nudge is the default option in retirement saving plans. The research has shown that when the employees are automatically enrolled in a retirement saving plan and have to actively opt out if they don't want to participate, the participation rates increase significantly. So this simple change in the default option nudges the individual towards saving for retirement without requiring them to take any action. Now, by taking the default option beneficial, more people are likely to make a better financial decisions. Now, for instance, sending the periodic reminders about saving for a specific financial goal or showing how the small savings change their spending habits can accumulate over time and can actually nudge the individuals towards a better financial behavior. And by simplifying the complex financial information using the visual aids, presenting the options in a very clear, lucid manner, the nudges can really help the individuals make more informed decisions, and the real world application of nudging in promoting a better financial choices, they are abundant. So the government and the organizations have employed the nudges in the areas such as retirement savings, debt management, and the insurance enrollment. This becomes more sustainable, and the nudges are intended to be transparent, non-coercive, and in the best interest of the individuals. So at the end, I would like to say that nudging in behavioral finance involves using a subtle cues or the interventions to influence the individual decision making in a very positive way, and by understanding the behavior biases and designing the choices, the environment accordingly, nudges can really help the individuals making a better financial choices. Thank you very much.